Hello, and welcome to the third edition of the U.S. Energy Insights. My name is Pamela Munger, and I'll be taking you through the latest market trends across U.S. and global energy trade flows powered by Vortexa's trading analytics platforms. Now, first, we're going to start off and take a look at what's been happening in crude flows. Now, after the announcement of the OPEC cuts, at first, we didn't see a big reduction in seaborne crude exports, but we are seeing that now. We've witnessed OPEC reducing seaborne exports, underpinned by the reduction predominantly coming from Saudi Arabia by about 10% month on month in July. Now, if we look at Russia, Russia has also reduced its seaborne exports, and they are falling around the same percentage points, 10% month on month. Now, this reduction in seaborne crude exports out of Russia is a seasonal trend, and you can see it by looking at this seasonal chart. Now, at the same time, what we are also seeing is a rise again in U.S. crude exports after a couple of lagging months. This has mainly been due to refineries coming back from maintenance, especially in PADD 3, using up that U.S. crude and disallowing it for exports. However, what we've seen in July is we've seen a massive surge of U.S. crude exports with record high flows hitting Rotterdam as WTI becomes part of the Brent pricing complex. Now, what has this meant for VLCCs? Now, VLCC rates dropped in the beginning of July. Well, it has caused VLCC rates to stabilize. And these VLCCs are ballasting in higher volumes back to the US Gulf Coast, taking WTI towards China as these trade flow reshuffle, and we see less volumes coming out of the Middle East. Now, this has certainly put a lot of pressure on the light sweet crude, and this increase in U.S. exports will likely drive light sweet crude prices even lower. Now, taking a look at China crude imports certainly remain relatively robust, but we are seeing a drop in imports month on month. Now, we're still waiting for China to really increase its refinery run rates. They've come off a long maintenance season. There are still refineries that are offline, which works in their system, and refining cracks in Asia in the last month have certainly directed refineries in the region to reduce runs. And you can see how Chinese crude stocks have been building. And this is an indication that the refineries have not run at full capacity yet. Now, let's take a look at what's going on in India. Now, India continues to import record Russian Urals in July, and this is largely at the expense of Saudi crude. And we can see this in this chart, the trajectory going downward, where India continues to import the Russian crude at the expense of the Saudi crude. Now, what's happening to Saudi crude? Saudi crude is now being redirected into Europe, and Saudi crude arrivals into Europe, especially directly from the Middle East Gulf, has been on the increase. But as European refiners also suffer from unplanned outages that continue to haunt the system, these Saudi crude arrivals are starting to plateau as a percentage share of total European crude arrivals. Now, let's take a look at the clean product market and what's going on there. Clean product margins are reaching levels unseen since Q1 2023 in Asia, Europe, and North America, while seaborne clean product export levels have surged above the 7-year range, as we can see from the seasonal chart. This is indicating that there's ample supply available. At the same time, we see crude prices move up due to various big producers cutting seaborne supplies, like I spoke about at the first half of this insight. What has changed recently to drive up the margins at a time of slow economic growth and rather high crude prices? Now, first, let's take a look at what's going on at the Atlantic Basin. Atlantic Basin gasoline margins are realistically and likely propped up by a reduced local supply and relatively low stocks. European gasoline exports, the dominant supplier to key markets, including PAD 1, West Africa, and Latin America, declined by 19% in the second quarter of 2023 compared to the same period last year. And this is likely due to a lack of blending components coming in from Russia and ongoing unplanned refinery outages. Meanwhile, total PAD 1 seaborne imports grew by 25% and Latin America by 9% in Q2 2023 compared to Q2 2022. While declining Nigerian demand, which has fallen by 15% when comparing those same quarters, has freed up some of these European supplies to flow elsewhere in the Atlantic Basin, volumes from Europe have opened up opportunities for the east of Suez growing gasoline supply. Not only is the east of Suez growing in refining capacity and producing more diesel, as we've seen in the previous charts, but it is also producing more gasoline. Matter of fact, new refining capacity in the east of Suez markets is expected to produce over 400,000 barrels per day of gasoline by Q2 2023. And this is putting a lot of pressure on local markets. Now, Oceania, dominated by Australian demand, which is starved by lack of refining capacity, has increased gasoline imports by 12% in Q2 2023 compared to Q2 2022. Meanwhile, imports into East Africa have doubled. And although Asian demand has been relatively resilient in light of recent economic downturn, we see barrels moving longer distances into the Atlantic Basin markets, supplying the major demand centers. PAD 1 imports from India increased by 25%, while Latin America gasoline imports from Asia increased by sevenfold in Q2 2023 compared to Q2 2022. The crux of it is that the east of Suez is finding homes for barrels previously filled by Europe, while servicing growing demand from Oceania, East Africa, and somewhat resilient local demand. If we turn our heads to the diesel market, we'll look at what's going on there and what's driving the market and margins rather, especially in the European sector. Now, overall, lack of European domestic supplies due to outages, unplanned and planned, but these ongoing unplanned outages really has underpinned the elevated diesel margins in Europe. And these diesel cracks have actually returned upward to March levels, hovering around $30 a barrel. And this is, again, largely due to stock draws from the stockpiling that had happened in the later portion of last year. There's Chinese exports coming into Europe in the latter half of 2022, and the last minute buying from Russia, but also strongly those intra-European flows. We saw European refineries really max out those diesel yields, and that compensated for those loss of Russian barrels in a big way. Also, east of Suez volumes also helped to fill that short left by Russia. But currently what we're seeing, because we're seeing so many of these ongoing refinery outages, Europe has not been able to resupply itself for diesel. In addition to that, the ARB from Asia has been closed for the last couple of months, even though we have seen steady flows from Middle East. This has caused Europe to look for the US Gulf Coast for resupply. And we've seen those volumes quite elevated in the last couple of months, especially when those PAD 3 refineries came back from turnaround. Meanwhile, in other markets, Latin American diesel import demand is down by 10% in Q2 2023 compared to Q2 2022, while Oceania is posting 20% gains in the same time period. And this is offering logistically closer support to the growing diesel production from the Middle East. Now, as we move closer to autumn, seasonally, we could see weakened demand for gasoline and an increased buying for diesel, despite the strength in the service sector, which pulls on gasoline, that has provided a lot of respite to the market from the industrial recession, which pulls on diesel demand. While there's continued support for refined product margins in the way of refinery outages, and that may last until the autumnal refinery maintenance season kicks in, diesel may have some upside if prices in Europe need to draw in volumes from Asia later on in the year. And at the same time, China is expected to announce a fresh batch of clean product quotas in early August, which may limit any upside potential in Asian refined product cracks, especially considering the current run-cut environment. And there is always the continued consideration for high Russian diesel exports to consider, but limited nearby destinations will mean a curtailed impact on European margins while pressuring the East of Suez markets. Well, this concludes our third edition of U.S. Energy Insights. We hope that you have enjoyed watching. Please like and give any comments or feedback in the comment section. Also, Vortexa is hosting an innovation series 2023 all across the globe in our main offices. So London, New York, Houston, Abu Dhabi, and Singapore. And these are all happening from September into October. You can register by clicking on the link, and it's a face-to-face talk on everything oil market and everything with respect to technology and innovation. So we hope to see you there. Thank you again. Bye.